Well, there have not been a lot of breakdowns with the pullback that we've seen, but certainly there is a meaningful loss of momentum. It's not just short term in nature, it's also intermediate term in nature. And that's what differentiates the current weakness with what we've seen previously, for example, late January. The loss of relative strength as well is very meaningful behind the NASDAQ 100 and related names like Tesla. Tesla is down about 40% from its highs, and actually the major indices have held up remarkably well considering that. But that downside leadership is also a meaningful shift, and it tells us that perhaps this pullback won't just mature very quickly, that instead it will give way to a period of sort of choppy sideways price action, something that unfortunately is quite frustrating and difficult to sort of more of a directional bias during.
Do you think technology has lost the majority of its momentum and relative strength?
You know, not the majority of. Certainly the long-term momentum is still very much positive around the world behind technology, behind the major indices, and really globally behind equities. And I don't think that will change throughout a consolidation phase. But if you look at the monthly or the long-term charts, boy, those uptrends are very, very steep. And there are some signs of exhaustion that suggest we could see up to 4 months of consolidation. And I think that would be healthy in the big scheme of things. But I do think that the valuation or the rotation from growth into value is meaningful because the ratios there have really broken down. So we're not seeing breakdowns in absolute terms in technology too much, but certainly in relative terms, those breakdowns seem to be real, albeit a little bit overdone in the short term. So in the short term, tech stocks are a bit more oversold than average. So I think we'll see a little relative stabilization there as we get a respite from that ratio. However, I do think it's meaningful in that it means that the value trade is really here to stay this year. And that suggests that stock selection will be way more important this year than it has been in the recent years, meaning it's not all about FANG plus M plus Tesla anymore, but rather will be rewarded by finding great stocks that can benefit from the economic recovery.
Okay, define value stocks. Value, Katie, is in the eye of the beholder. Some people say it's only oil and gas or other beaten up stuff. So you say value still looks good. What still looks good inside of value?
So for me, it's a setup from a technical perspective that really reflects value. So these aren't the stocks that have reached new multi-year or all-time highs and well-established uptrends, but rather those that advanced from basing phases in Q4 of last year. You're finding that setup primarily in energy, in financials, selectively within industrials and materials, more cyclical areas of the market. There's still some great setups in technology, of course, from an absolute perspective, but of course, those are relatively overbought when you take a ratio of each of those individual stocks to the broader market or major indices. So I think there's a little bit more upside or room for outperformance from the value arena with that in mind. And there's some great setups out there. I also think that with additional near-term weakness, we could get some rotation that's a little bit more defensive. And we really haven't seen that until very, very recently. I think a great case in point would be Procter & Gamble. PG has come well off of its lows after having lagged for many months. And that inkling that we have improved short-term momentum behind consumer staples could be informational.
Shepard Smith here. Thanks for watching CNBC on YouTube.